Done. Good evening, my dear students. Welcome to the session on input tax credit, CA final indirect tax laws. Hope all of you have remembered all the provisions with regard to the ITC chapter, section 16, section 17, input service distributor concept, blocked credits, and also the method of apportionment of credit in case of capital goods, which are commonly used for taxable and exempt supply, for business purpose and personal purpose, and all such various things. So we were working out a number of problems in the previous session. Now we come to section 18 also was covered. All these rules were covered. So let us come to what was left out, the theory portion in the chapter. That is the method of utilization of credit. Section 20 also was covered. That is your input service distributor also was covered. We did some problems based on this. Also distribution of credit, rule number 39 with regard to input service distribution was covered. So what was left out in this particular chapter is your utilization of the input tax credit. See, basically section 49 speaks about how the various forms of tax need to be paid to the government. That is what is covered under section 49. So here we are not going to discuss everything in section 49 because you have a separate chapter for that. That is accounts and records and payment of tax. There is a separate chapter for that. What we are going to see only here, since we are discussing the topic of input tax credit, we are just going to see as to how the credit of the IGST, CGST, SGST, etc. shall be used and how it shall be adjusted against the output taxes. That is what we are going to cover in our discussion today. So section 49, we are only going to see the relevant extracts which pertains to adjustment and set off of the input tax credit. So 49 subsection 5 says the amount of input tax credit available in the credit ledger of the registered person on account of indirect integrated tax shall be first utilized towards the payment of IGST, and anything which is remaining shall be utilized towards the payment of central and state tax, or as the case may be, union territory tax in that order. So if you recollect, in the first session, very first session, we had spoken about the types and methods of utilization of the tax. Okay, types and methods of utilization of the tax. So here what we are going to cover is how you are going to utilize the tax. So here when I talk about IGST credit should be first utilized against IGST, and whatever is left out, you can utilize in any manner as you want between CGST and SGST. This you have seen in the first class itself. This is what section what covers that. And the second one which talks about the credit of central tax, that if the CGST credit is there, the CGST credit first will be used towards the payment of CGST, and if there is any amount remaining, it will be used towards the payment of IGST. This is what is also the second point which is covered. So CGST first used against CGST, and whichever amount is remaining, it will be used towards the integrated tax. Then coming to the next last one, the state tax will be first utilized towards the payment of state tax. Whatever is remaining will be used towards the payment of integrated tax. This also is very clear, which we have discussed that. Fine. Then a proviso is covered in this particular section, which says that the ITC on account of state tax will be used for the integrated tax only when balance of ITC on account of central tax is not available for payment of integrated tax. That means what? CGST credit has to be first exhausted. CGST credit needs to be first exhausted in the payment of IGST. Only after that you can use the SGST tax. So SGST used only towards the state tax. It can also be used towards the integrated tax. But the main condition here is first the credit of central tax needs to be exhausted. Only if there is no credit of central tax which is available, only then you should come to the SGST in order to adjust against the IGST. That is the provision which is given. Same way, the union territory tax first utilized towards the payment of union territory tax. Whatever amount is remaining, it shall be used towards the payment of integrated tax. Very simple, just like SGST, CGST, UTGST also is covered. Again, a similar provision is there that Union Territory GST you can use for payment of integrated tax only once the credit of CGST is completed. What is the logic behind this particular provision? The logic is the central tax and the integrated tax both go to the central government initially. Later, the central government settles the state government. So set off adjusting CGST and IGST is more easier because both go to the central government. So if you are adjusting one against the other, there is no revenue loss temporarily to the central government. So that is precisely why the rule is there that the CGST credit has to be first exhausted before you can touch the SGST and UTGST credits. Then, next one, the central tax shall not be used towards payment of state tax. This is very simple. If you have a CGST credit, you cannot use that for paying the state credit or the UTGST credit. Similarly, the state credit also cannot be used for payment of central tax. This is very, very clear. Clear-cut restriction is given. So that was the way of set off in case of credit. Yeah, Sham, example on distributing the credit of CGST and SGST, where recipient and ISD are located in different states. I think we did a problem based on this in the last session. If in case we have not done it, we'll again cover on similar problem today. Don't worry about that. How to distribute the credit of CGST and SGST? Definitely, we'll do a problem based on that one, Sham. Don't worry. Good evening, Viraj. Yeah. So now, now we come back to our discussion. So here, 49A speaks about utilization of ITC subject to certain conditions. So notwithstanding anything contained in 49, input tax credit on account of central tax, state or union territory shall be utilized towards the payment of the integrated tax central or union territory only after ITC available on account of IGST has been fully utilized towards such payment. Another important condition that first and foremost, whenever you are looking at the utilization of input tax credit, first thing what you have to make sure is that the credit of the integrated tax is used entirely towards the payment. Only after the credit of integrated tax is used, you come to the CGST and SGST credit. That is what is given under 49A. Important thing to remember, first make sure that you use the integrated tax credit towards the payment. 49B talks about order of utilization of credit, notwithstanding anything contained subject to the provisions of 49E and F, 49 5 E and F, which is what we just read. E and F is nothing but CGST not to be used against SGST and vice versa. So, notwithstanding anything and subject to those provisions, the government may prescribe the order and utilization of credit of the IGST, CGST, SGST, etc. towards the payment of such tax. So, therefore, 49B mentions that the government shall prescribe on the recommendations of the council, the government shall prescribe the order and manner of utilization of the ITC on account of these taxes towards the payment of such tax. That is your 49B. Rule 88 capital A speaks about the order of utilization of input tax credit. How you are going to utilize the input tax credit is covered in this Rule 88A. On account of integrated tax, if any input tax credit is there, it shall be first utilized towards payment of integrated tax, and anything which is remaining will be used for central and state tax in any order. That is your wish. So ITC credit of IGST first you should use. Anything of the ITSC credit which is left out, it is up to you. You can choose how you want to distribute it between the CGST and the SGST. Then in case of, this also we have already seen, in case of input tax credit of CGST, SGST, etc. shall be taken into utilization only after the IGST credit has been utilized fully. So first priority, whenever you are coming to set off and utilization of input tax credit, is to see that the credit on account of integrated tax is first utilized fully. That is the most important thing which you have to remember. Fine. Some important points let us discuss. ITC, as always, is first credited to the person's electronic credit ledger. The person is entitled for the ITC on CGST, SGST, IGST, depending on the nature of supplies received by him. Very simple. The person will use the ITC for paying the output tax liability. Indian GST is a dual GST. where they are both levied on a concurrent supply transaction. CGST always comes to the central government, SGST, UTGST goes to the state and union territory respectively. ITC, as we already saw, SGST, ITC can't be used towards payment of CGST. CGST, ITC can't be used towards the payment of SGST. It is totally not permissible. IGST is a transitory tax. What do you mean by transitory tax? That is, it is collected on the interstate supplies. That is, initially it is collected by the central government and it goes initially to the central clearing authority. And ITC of IGST can be used for payment of CGST, etc. So cross utilization definitely in this case is permissible. Flexibility has been provided to the taxpayer to utilize the ITC on payment of CGST in any proportion in any order. Fine. The moment the ITC of the IGST is used for the payment of SGST or UTGST, the correspondent debit or credit is made to the respective state government or union. Moment you use the ITC, to that extent, accordingly the credit is given to the state government or the union territory. That is how the system of IGST first collection and then adjusting to the state government works. So if we summarize the utilization, this is very, very important. You will be working some problems also based on this. How it will be, it will not appear to you as a single problem, right? This question, this will not come as a single problem, but it will form part of a consolidated problem for you, wherein this concept also we have to remember very carefully. Only then you'll be able to understand and work out in the problem. So very simple. First priority, look at IGST. IGST credit you have to totally exhaust. First use towards payment of output GST. Next you can use for CGST or SGST as per your wish. And before utilization of CGST, SGST credits, that is before you come to the next step, you have to make sure that the credits of IGST are exhausted fully. Okay, credits of IGST need to be exhausted fully before you come to the next step. Next step is CGST credit. First towards payment of output CGST. After that, used for the payment of IGST. Okay, it cannot be used for the payment of output SGST. So ITC of CGST cannot be used for the payment of output SGST. Very simple. Then now you come to ITC of SGST. First you will use for the payment of output SGST. Next you will use for the payment of output IGST. Cannot be used for the payment of output CGST. Fine. So these credits are very, very important for us to remember for the examination point of view. So if you look at an example here, let us see what are the output tax liability and what is the input tax credit which is available here. Headwise it is given. Output tax liability under IGST is 1,000 rupees, under and the ITC is 1,300, CGST is 300, ITC is 200, SGST is 300, and ITC is given as 200. Very clearly given. So if you see here, how do you manage to do the adjustment is what is important point here. So if you go to the first step here, IGST, ITC, you have to first attack. You always take into account the ITC of the IGST. Then you come to the next step. So ITC of IGST here is 1,300. How you will use against this? First utilize against the IGST 1,000. Then there will be 300 rupees of ITC which is still left out of IGST. You can use it in any value. Here CGST output is 300, SGST output is 300. So you'll use, let us assume 200 you use towards CGST, 100 you use towards the SGST. So thereby the ITC of IGST totally gets exhausted. After that, you come to the ITC of CGST, which is 200 rupees. How it is 200 rupees? Because 100 rupees it can be used anymore. So ITC of IGST have been used. So if CGST, IGST is 200 rupees. So how much of CGST is still left out? After you have adjusted 200 rupees above, 100 rupees is still left out. So 100 rupees you will adjust and balance credit will continue. Balance credit of CGST will continue. It will not be adjusted against SGST. Now coming to SGST, 200 rupees is the credit, 300 is the output tax liability. Straight away you will use 200. SGST credit totally exhausted. So this is precisely how you work out the utilization of credit with regard to section 49 as well as the respective rules. Now, rule number 86A talks about the restrictions which are placed on utilization of input tax credit. What are the restrictions which are given? with regard to utilization of input tax credit. Fine. So in certain specific circumstances, the restrictions can be imposed on the claim of the input tax credit. When will that happen is what is given in rule number 86A. The first thing, where the registered person availing the ITC has been found non-existent or not to be conducted any business from the place of business. That means you have a GST registration and you have claimed the input tax credit. But actually you're not at all there. That company is not at all there. It is not existing. You just created on a paper and took a GST registration. It is not at all there. If you go to that address, nothing is there. Or second one, not existing or not conducting any business. Registered place of business is there, GST registration is there, but there is no business which is happening. In these cases, input tax credit can be restricted. The government can place an unconditional restriction on availment of input tax credit because it has the suspicion that that person is not existent or business is conducting from the registered place of business. Or the registered person availing the input tax credit is not in possession of the tax invoice or valid document, right? So that means you are whatever claiming the input tax credit, you don't have the necessary invoice. You don't have the valid document for claiming the input tax credit. So that is why this also is a second point which you have to remember. But if you are availing the input tax credit in these circumstances, the restrictions can be imposed by not allowing the ITC. Okay, if you are availing the input tax credit for discharging the output tax liability, you need to use the input tax credit. So therefore, restriction can be imposed by not allowing it to be used under 49 or not allowing refund of any unutilized amounts of ITC. Restrictions can be imposed up to 1 year from the date of imposing such restrictions. Okay, restrictions can be imposed up to 1 year from the date of imposing restrictions. However, restriction can also be withdrawn if you satisfied that the conditions no longer exist. So therefore, 86A therefore is something like a cautionary rule. It is a rule which says that if you try to avail the input tax credit after not satisfying certain conditions, definitely we can impose any particular restriction on that. So you will have to make sure that you do that. So that is an important point which you have to remember. Then the commissioner or an officer not below the rank of the assistant commissioner authorized by him is empowered to impose the restrictions on the utilization if he has reason to believe that ITC has been fraudulently availed or is ineligible. So ITC fraudulently availed or ineligible. Okay, you are not claimed the input tax credit. Okay, it is fraudulently availed or it is ineligible. In these situations, restrictions on utilization of ITC can be imposed by the commissioner. Okay, so therefore, what are the following circumstances? Non-existent supplier is there, he is issuing a tax invoice, or person not conducting any business without the receipt of goods or services, or the tax which has not been paid to the government. In these situations, the restrictions can be availed. Then 86B speaks about the restrictions on the use of the amount which is available in the electronic credit ledger. 86B, restrictions on the use of the amount which is available in the electronic credit ledger. That means here what is happening, you have already claimed the credit, because how it works is you purchase a particular material. The supplier files his GSTR1. Once he files his GSTR1 for you, it will be visible in your GSTR2B, which is nothing but your input tax credit. You claim that input tax credit. The moment you claim that input tax credit, it goes and sits in your electronic credit ledger. The moment it sits in the electronic credit ledger, the restriction can be placed. That was Rule 86B, saying that input tax credit can be, whatever use is there, it limits the use of input tax credit, which starts with a non-obstant clause. That means straight away restriction is given, overriding impact on other provisions of the rule. 86B is applicable to a registered person having value of taxable supply in a month exceeding 50 lakhs. That means this rule 86B, you cannot give that restriction to everyone. You can give the restriction only to a specified person, which is mentioned here. Who is that person? In 1 month, value of taxable supplies exceeds rupees 50 lakhs. So therefore, whenever in the value of the taxable supply is less than 50 lakhs per month, then straight away this restriction is not applicable. Very simple. Therefore, please make a note, 86B is applicable only when the value of taxable supply in 1 month exceeds rupees 50 lakhs. If it exceeds rupees 50 lakhs only, this rule 86B is applicable. Right? Then the registered person to whom the said rule is applicable cannot utilize ITC in excess of 99% of the output tax liability. Very, very interesting, very, very unique point. That means, what does it say? The rule 86B does not debar the credit totally. It says you claim the input tax credit, no problem, but you cannot utilize it in excess of 99% of the output tax liability. That means, if the output tax liability is 100 and in your you have claimed the credit of 120, amount which is sitting in your credit ledger is 120. You can claim the credit only up to 99% of the output tax liability, which is nothing but 99 rupees. That credit also will be there in the credit ledger, but it is on the credit will be only to the extent of the output tax liability. This is what is rule 86B, the amount restriction in the credit ledger. Fine. I hope this is clear. Let us take an example here. The total value of interstate supply of Anu and Sons for the month of Feb 21 is 100 lakhs. Said supply is taxable at 18% GST. Thus, total output tax liability of Anu and Sons is 18 lakhs. Amount available in credit ledger is 20 lakh rupees. So what is happening here? Total output tax is 18 lakhs. That means 99%. So for month of February is 100 lakhs. That is, in 1 month he has supplied more than 50 lakhs. Straight away rule 86B will apply. Straight away rule 86B will apply. So 17 lakh, if he does this 18 lakhs into 99%, 17 lakh 82,000 is the maximum input tax credit. Balance of 1% he has to do discharge through cash. Fine. That is, I hope it is clear. Yeah. And then, however, some exceptions are there. Where a person has deposited more than 1 lakh as income tax in the last 2 financial years, for which the time limit of filing return has expired, for which the time limit to file the return of income under 139(1) has expired. So last 2 years, if the person has deposited more than 1 lakh rupees as income tax in the last 2 financial years, more than 1 lakh he has paid as income tax, like by declaring the tax or the TDS, etc., he has paid the income tax. Then in that particular situation, okay, the registered person or Karta or any of the person, for all these persons, the rule will not be applicable, right? So therefore, any person mentioned below, if he has furnished more than 1 lakh income tax, who is the registered person or the Karta or managing director, any 2 directors, members of managing committee, or even in case of zero rated supplies, because zero rated supplies, there is nothing on outward supply. So definitely that rule will not applicable. Inverted duty structure. What is inverted duty structure? You will learn it in the refunds chapter. Output supply is there. If output supply tax is very less, say somewhere around 5% or 6%, but inputs and all is somewhere around 12% or 18%, it falls under IDS, which is called inverted duty structure. So therefore, in this case, pertinent to note that the refund should have been received in the preceding financial year. Fine. Refund should have been received in the preceding financial year. That is what is the exception which is given in this particular situation. Fine. So therefore, that is what is this thing. Another exception in case of 86B, payment of total output tax liability in excess of 1% of total output tax liability. So more than 1% of output tax liability. So whichever is the output tax liability, more than 1% if you have paid through the cash ledger. When I say paying through the cash ledger, that means you actually pay through your bank account. You don't utilize the credit which you have in discharging the tax. So more than 1% of total output tax liability, if it is paid through the cash ledger, the restrictions which is given in 86B shall not apply. Fine. Let us take an example. FY 21-22 up to August 21, total tax liability is 30 lakhs. Registered person has deposited 1 lakh through electronic cash ledger, balancing through electronic credit ledger. It will not be applicable because payment in cash is more than 1% of the total output tax liability. Nothing but 1% of 30 lakhs is 30,000. But how much he has paid through cash ledger? 1 lakh he has paid. So therefore, in this particular situation, Rule 86B does not apply. Similarly, apart from this particular case, Rule 86B also will not be applicable in case of the following persons. Who all are covered here? Government department, public sector undertaking, local authority or statutory body. All these four are covered here. However, the commissioner or officer authorized by him may remove the restriction after such verification and safeguard. So in these four cases, Rule 86B will not be applicable. Fine. Try to work out this problem. Determine the amount of tax payable through electronic credit ledger or cash ledger from the given information. Taxable turnover of ABC Limited in the month of February is 1 crore 25 lakhs, excluding zero rated and exempt supply. Total amount of ITC for the month of February 25 lakhs. Amount of input tax credit as per GSTR 2 is 23 lakh 10,000. Applicable tax rate 18%. What is the amount of tax which is applicable to be paid through the electronic credit or cash ledger is the question. Please try to answer this question. Yeah. Sir, when can we take the balance sheet? No, it will not lapse. Viswaranjan, it will not lapse. This is just a condition wherein to ensure and track that some amount of cash is always paid, because many of the cases, if you underreport the sales, it will go on keeping on carried forward. So this particular rule is basically instituted to make sure that all the ITC is genuine. So it will not lapse. It will keep continuing in the coming months. So therefore, in this particular problem, if you see, 2A or TP is 23 lakh 10,000. So whatever input tax available is actually 23 lakh 10,000. Book available as per the books is 25 lakhs. That is not relevant for us because straight away we have to claim as per the 23 lakh 10,000. Okay, applicable tax rate. So 1 crore 25 lakhs is the sale. On this 18%, if you pay, is 22 lakh 50,000. Okay, so on this, the tax payable is rupees 22 lakh 50,000. So this is the tax which is payable. So therefore, you can claim up to 99% of this 22 lakh 50,000 into 90% you can claim, which is 22 lakh 27,500. To this extent, you can claim. And the balance of C, because 22 lakh 50,000 you have to pay, you can claim 2227,500 from the credit. Balance 22,500 you have to pay through the cash ledger. You have to pay through the cash ledger. So I hope this problem is clear. Fine. So this problem I think we covered in the last class. Did we do this in the previous session? I think we have done that. Yeah, and there is a problem on this. Okay. Anyways, let's look at this problem because we did a similar problem last class, but I'm not sure. But let's look at it. It's a pretty simple problem here. Siddhi Limited is a registered manufacturer. Purchase the following goods during the month of January. Following particulars are provided. Capital goods purchased on which depreciation has been taken on full value, including GST paid thereon, 15,000. Goods purchased from Ravi Traders. Invoice is received in month of January, but goods were received in the month of March. Car purchased for making further supply of such car. It is destroyed in the accident while used for test drive by potential customers, 30,000. Goods used for setting up telecommunication towers is 50,000, and trucks purchased for delivery of finished products is 80,000. Determine amount of ITC available with Siddhi Limited by giving necessary explanation for the treatment of various items. Please try to solve this problem. Yeah. Any answers for first one? Yeah. So if you see here, capital goods are purchased on which depreciation has been taken on the full value including GST. So on 15,000 rupees capital goods purchased, but depreciation has been taken by in full way. So if you see here, depreciation, if it is claimed on the tax component also, ITC cannot be claimed. So therefore, in this particular situation, since depreciation claim, ITC is not allowed. Okay, very simple. Since depreciation is claimed, ITC is not allowed. Then goods purchased from Ravi Traders, invoices in the month of Jan, goods received in the month of March. So if you see here, one of the important conditions as per section 16 subsection 2 with regard to goods is that they have to be received. Okay, the goods have to be received, only then ITC can be claimed. Since goods therefore are not received in Jan, ITC cannot be claimed. You have to write it more elaborately as per the provisions of the CGST Act 2017, or if you remember the section as per section 16 subsection 2 of the CGST Act, in case the goods are procured from Ravi Traders, the condition is that the credit can be claimed only on the receipt of the goods. Since the goods are not received, in that case ITC cannot be claimed. So on this 20,000, no ITC can be claimed. So this 15,000, no ITC. On this 20,000 also, no ITC. Then car purchased for making further supply of such car is destroyed in accident while being used for test drive by the potential customers. Though motor car is an ineligible credit as per 17 subsection 5. If a person is there who is engaged as a dealer of motor cars, that is who purchases and sells the motor cars on a regular basis, in that particular situation, the input tax credit is actually allowed. Now, if such a car is destroyed in an accident when being used for test drive by potential customers, if they are destroyed in the accident, 17 subsection 5 clearly places a restriction. 17 subsection 5 clearly places a restriction that in this particular situation, if the goods are destroyed, if the goods are destroyed as per the 17 subsection 5, ITC is not available since the goods are destroyed. So these are actually goods, you can claim the ITC, but since they are destroyed, ITC cannot be claimed by virtue of section 17 subsection 5. So that means this particular point falls in a different limb of 17 subsection 5. That is the important point which you have to remember. Fine. So therefore, since goods are destroyed, it will have to fall in a different in a point of 17 subsection 5, and ITC cannot be claimed. Goods used for setting up telecommunication towers. If you see the setting up of telecommunication towers also, that means it is used for the building. So he is a registered manufacturer of goods. So for the setting up of telecommunication towers means he's using the goods on his own account. So therefore, if he's using the goods on his own account for the purpose of construction or works contract on his own account, if he does, then in that particular situation, ITC cannot be claimed. It is very, very clearly given. And telecommunication is excluded from the definition of plant and machinery. So therefore, for this also not allowed. ITC cannot be claimed as goods used for construction on own account, right? Specifically restricted by 17 subsection 5. So here also no ITC. Here also no ITC. Truck purchase for delivery of finished product. If you all remember, in the previous session also we did a discussion that if any motor vehicle is there for the delivery of goods, for that credit is eligible. 17 subsection 5 refers to motor vehicles only engaged in transportation of persons or passengers. So therefore, any truck engaged in delivery of goods, ITC can definitely be taken. So therefore, amongst all this, ITC can be taken only with regard to the truck which is used. So therefore, the answer here is 80,000 rupees. So amount of ITC which is available is 80,000 rupees. That is only for this truck we can claim the ITC. Others cannot, we can claim as the ITC. Fine. I hope this point is clear. Now someone asked an example of ISD. This is what we are going to do. Though destroyed, car destroyed, ITC available. No, ITC we cannot take on the destruction of car, because though motor car is a stock, ideal if this car was not destroyed, he could take the input tax credit. But here what is happening? The car is destroyed, and after the car is destroyed, the moment you are procuring the ITC for a product and the product is destroyed, you cannot claim the input tax credit on account of the provision which is clearly given in 17 subsection 5. Now we go to the next question. Sarani Weavers at Pune, Maharashtra is a registered input service distributor and intends to distribute ITC for the month of March. The following are the details which are available for such distribution. Rajasthan branch last quarter turnover 10 lakhs. ITC specifically applicable to the branch IGST 12,000, CGST 3,000, SGST 3,000. Madhugiri branch Karnataka turnover of last quarter 5 lakhs. ITC specifically attributable is nothing. Kosala branch UP turnover of last quarter 15 lakhs. ITC specifically applicable nothing. Mumbai branch Maharashtra turnover of last quarter 20 lakhs. IGST is 1.5 lakhs. CGST 15,000 and SGST 15,000. So these are the specific inputs which are given. Apart from this, ITC which is used on input services commonly by all the branches are also given. The common amounts are CGST 60,000, SGST 60,000, IGST 1,20,000. And one more thing is IGST ITC of 10,000 pertaining to March last year was inadvertently not distributed. Whether you can distribute it now is the question which is asked. Madhugiri Karnataka branch uses input service to manufacture exempt products. Turnover include duties and taxes attributable. Determine the manner of input tax distribution. This is what is the question which is asked. Please try to answer this. Thank you for clearing concept. Yeah, my pleasure. I hope you got the concept. Very confusing that was. Car used for this drive but destroyed. If it not destroyed, you can claim the input tax credit, because for dealer it is exempt. As in the dealer can claim the input tax credit. Yeah. Yeah. So therefore, if you look at this particular question, you have to see how much GST is attributable where and how you have to distribute it in this particular situation. So coming back to the question. Now here, Pune, Maharashtra, Sarani Veeravas is there. So that means the ISD registration is in Maharashtra. And ISD registration is to be done for the month of March. Following are the details. So last quarter turnover for Ganganagar branch Rajasthan is 10 lakhs. ITC specifically applicable to the branch is given here, right? So therefore, if you see here, CGST, SGST, IGST put together, it is 18,000 specifically attributable to the Ganganagar branch. In this particular situation, even though the CGST, SGST is there, which is paid, and IGST of 12,000 is there, this 18,000, when this Sarani Weavers ISD distributes to Ganganagar, it will distribute the 18,000 as IGST only. Why? Because this Ganganagar branch and ISD, that is Sarani Weavers Pune, are in two different states. So therefore, when Pune Maharashtra distributes the ITC to Rajasthan, it will distribute the same as IGST only. So therefore, in this particular situation, 18,000 will be distributed as IGST. Then Madhugiri branch 5 lakhs, there is no credit, so no need to do anything. Kosala branch 15 lakhs, there is no credit, no need to do anything. Then Mumbai branch, if you see here, 150,000, 15,000, 50,000 are there, but both are located in the same state in which it is there. So as it is, the credit shall be distributed. Since this ISD and since this Mumbai branch are in the same state, as it is, that is IGST 1,50,000, it will be distributed as 1.5 lakhs IGST. CGST 15,000, it will be distributed as CGST. SGST 15,000 will be distributed as 15,000. That is with regard to the credits which are specifically attributable. Now coming to the common input tax credit, which are used by all the branches, those details are also given. CGST, SGST 1,20,000, total is 2,40,000 is given. So in this case, you have to divide it by the turnover. So 2,40,000 is the total credit. What is the turnover of the each branch? 10 lakhs, 15 lakhs, 15 lakhs, 20 lakhs. So total turnover is 50 lakhs. So 2.4 into 10 by 50 is how you have to distribute the credit. Fine. I hope this point is clear. So how do you distribute the credit also? You will see. So therefore, in this particular situation, these three will be distributed as IGST credit. All the three. Okay. Write it here otherwise. All above three to be distributed as IGST credit, because ISD and branch are in two different states. Fine. I hope this is clear. Then we come to Madhugiri branch, Karnataka 5 lakhs. In this case, nothing needs to be done here. In this particular situation, as it is, because same state. So in this case, all three in same manner, since branch and ISD in same state. This is what has to be done with regard to ITC of Mumbai branch. Now, if you see on the common inputs, how do we do it? On this, it is totally based on turnover. Totally based on turnover. So total taxes to be distributed comes to rupees 60 plus 60 plus 110, 2,40,000. So how to distribute? If you first look at this one, that is your Ganganagar branch. Ganganagar branch, if you see, turnover 10 lakhs, 15 lakhs, 15 lakhs, 20 lakhs. So total turnover comes to 50 lakhs. Okay. So total turnover is rupees 50 lakhs. Okay. Total turnover is 50 lakhs. So how much to distribute to Ganganagar? So therefore, Ganganagar branch will be 2,40,000 into 10 lakhs by 15 lakhs. Is the way you have to bifurcate the list. Now, since Ganganagar is in a different state, so 2,40,000 into 10 divided by 50, 48,000. Since it's in a different state, distributed as GST. Okay. Now we come to the second one, which is your Madhugiri branch. Okay. Madhugiri branch also will be 2,40,000. What is the turnover in Madhugiri? 5 lakhs is the turnover in Madhugiri. 2 lakhs into 5 lakhs by 50 lakhs, which comes to 24,000. This also distributed as GST. Okay. Next one is the Kosala branch. Again, this is interstate only. Kosala branch. Okay. 2,40,000. What is the turnover of Kosala branch? It is 15 lakhs. 15 lakhs divided by 50 lakhs, which comes to 2,40,000 into 15 divided by 50 rupees 72,000. Again, distributed as GST. Distributed as GST. Okay, I hope this is also clear. Okay, these three are clear. Now we come to the fourth one, Mumbai branch. Mumbai branch. How do you do this? You have to do it as per CGST, SGST, and IGST. So if you see here, Kosala branch, I hope it is clear. Okay. In this case, how do we do the credit? You have to multiply but each turnover. Okay. Which is CGST, SGST, IGST to be separately taken. CGST, SGST, and IGST to be separately taken. Okay. If you see CGST here, it is 60,000. Okay. 60,000, SGST 60,000, IGST 1,20,000. Fine. So therefore 60,000 into 20 lakhs by 50 lakhs. Okay. So this comes to 24,000. Similarly, SGST also will be rupees 24,000. IGST will be how much? IGST will be 1,20,000 into 20 lakhs by 50 lakhs. Okay, which comes to 48,000 is IGST. Right? This is how you do the bifurcation. Now, if you see, there is also one rider in this question here. That is, last time's ITC, can we do it? Okay. Here, if you see, there is one question. If you just fine. There was one line here. 1 minute. Let me see where that line was. Not able to find it. Give me a moment. I think it has just disappeared somewhere. This one. Let me just check where it is. Yeah. There was one line in the question here. Here it is mentioned as here. I'll just copy paste it here. This was what it is there. When we just worked out the solution, it seems to have disappeared. This is what is given. ITC of 10,000 pertaining to March was inadvertently not distributed. Whether the same can be considered for distribution. So therefore, this is definitely not allowed. And Madhugiri branch uses input to manufacture exempt products. Turnover excludes duties and taxes payable to central and state government. Determine the manner of input tax distribution. So if you see here, in this particular situation, the credit whatever is distributed is important here. So if you see how it has been distributed, it is totally based on the turnover of each particular states. One second, some issue with the laptop, it has got stuck. Yeah, so I hope this point is clear. So whatever is there in the March last year will not be able to take now, because that is definitely not allowed. Okay, that is one important point which you have to keep it in mind, because whatever ITC is there for that month, it has to be distributed. So therefore, in this particular situation, if you see, this ITC of 10,000 should be distributed in last year March on. You cannot carry it forward further. So therefore, that is not allowed. Fine. So that is the way in which you have to work out the problem. Madhugiri Karnataka branch uses the input service to manufacture exempt products. If you are using this input, definitely you have to reverse it as per rule number 42. But presently, credit to electronic credits anyways happen. So that will anyways take time. So therefore, if you see, this was the solution based on what we did. Fine. If it is in different states, ISD and the branch, distribution shall be done as IGST. If it is in the same state, as per CGST, SGST, SGST, it will come. And that is what is this. Fine. This is the way you have to work out the problem. Fine. I hope this point is clear. Now we get to other problem. George Private Limited, a registered supplier of goods at Kerala, who pays GST under regular scheme, has made the following transactions exclusive of tax during a tax period. Purchases 5 lakhs from a registered dealer in New Delhi, sales 10 lakhs to a registered dealer in New Delhi, tax rate IGST, CGST, SGST as given, 2,50,000 purchases from registered dealer in Trivandrum, Kerala, 8 lakhs sales to registered dealer in Trivandrum, Kerala. Company has complied with all the conditions for availing the input tax credit. Following further information is there regarding the balances available on the first day of the time period. Source tax interest penalty is given for all the three. Calculate the minimum net to CGST, SGST and payable for the tax period, and also the ITC to be claimed to the next period. So in this is a simple problem based on what is your sales to interstate sales, and you have interstate purchases, you have intrastate sales and intrastate purchases. You have the total taxes with regard to the ITC, how you are supposed to set off the credit. So this is a problem which is based on set off of the credit in the payment of tax. How you are supposed to do that, you will get to do this problem. So try to work this out. Please try to work out this problem. Available IGST is 1,20,000 and to be distributed 1,40,000. What is to be done? Where is this happening? One second, let me go back to this. I didn't understand your doubt. Available ITC is 1,20,000. Where is that? IGST is 1,50,000, right? IGST is 1,50,000. How did we get 1,20,000? Okay. I'm coming here. Yeah. Okay. Got it. CGST, SGST, IGST credit of 1,20,000 is there. Okay. So basically, you're telling since 1,20,000 is there, but you have to distribute higher ITC. ITC we have distributed exited. That means ITC of IGST we have distributed is exceeding the ITC of IGST available with the IGST. Definitely. So whatever we are distributing here, see, total of IGST credit of 1,20,000 is there. So how much IGST credit you are giving? In this case, 48,000 is there, then 24,000 is there, 72,000. Definitely IGST credit is more. you will have to convert the credit because the branch is located in another state altogether. So since the branch is located in another state altogether, definitely though the credit is the IGST credit is less, whatever CGST, SGST credit you have, it will convert into the IGST credit because you are allocating the credit to a different branch. That is the concept of the input service credit distributor distribution of the credit. Fine. I hope it is clear. Available credit is 1.2 to be distributed 1,44,000 is correct. You distribute it from the CGST and SGST because that CGST and SGST are distributed to another branch outside your state. So therefore, it will be distributed as IGST. I hope this point is clear. So therefore, if you see here in this particular question, you have to see how the, or first you have to work out the output tax, how much it comes to, and then you have to carry forward the, adjust the set off of the input tax credit. So this is basically this problem. You have to ask what is the minimum net GST, IGST payable for the tax period, and also ITC which is to be carried forward. So if you look at this, first you have to look at the sales which are made outside the territory, IGST sales. So what is the total sales which he has made outside? 10 lakhs. So to this 10 lakhs from Kerala to IGST space, so on this IGST will be applicable. So on this IGST will be applicable at 18%. 18% of IGST comes to 1,80,000. So I hope this is clear. 1,80,000 is the IGST which is applicable. Now we come to sales which is made in Trivandrum. What is sales which is made in Trivandrum? 8 lakhs. 8 lakhs on this CGST 9%, SGST 9%. Why? Because it is made within the state of Kerala. So I hope this point is clear. 72 CGST. So what is the total output GST? Output GST on total sale of 18 lakhs. 72,000 is CGST. 72,000 is SGST, and IGST comes to 1,80,000. This is the total output GST which is applicable. Now we have to look at what is the ITC which is eligible. So if you look at the ITC which is eligible, you have to see the purchases of 5 lakhs from registered dealer. So that means IGST credit is 5 lakhs into 18%, which is 90,000. Then similarly, 2,50,000 CGST, SGST. 2,50,000 into 9%. So 22,500 each. So 22,500 CGST and 22,500 SGST. Okay, this is very much which is applicable here. Fine, and here it will be 90,000 IGST. Okay, this is also clear. So there, now if you're coming back here, so ITC, IGST here in this particular situation, total IGST, how much is there? Total IGST is 90,000. Again, there is some credit which is already sitting. So 90,000 IGST is on this one. Okay, and there is a credit which is sitting of 1 lakh. So total IGST here is 1,90,000. First, you should always look at 1,90,000. So out of this 1,90,000, what is to be done? First, utilize it against output IGST totally. So first thing you have to keep in mind is exhaust the ITC credit. So from 1,90,000, exhaust the ITC credit first against output IGST. So output IGST is 1,80,000. So from that 1,90,000, take this 1,80,000 as the ITC for IGST, and therefore here it will become nil. That means output IGST will be totally adjusted against the IGST credit. After IGST credit is still 10,000 is remaining. First priority, exhaust the IGST credit. The 10,000 you can adjust however you want. In this example, we have assumed that you have adjusted against SGST output, but you can adjust against CGST or equally also. No restriction in that. So in this case, we are seeing the 10,000 of IGST ITC which is left out. We are adjusting against SGST of 72,000 output. Fine. So with this, IGST credit gets completed. Next, we come to CGST credit. What is the CGST credit which is there? 22,500 here, and here it is 50,000. 72,500 credit is there. 72,500 CGST credit is there. So therefore, CGST credit is 72,500. Again, CGST credit can be used only against to make the first payment of CGST. IGST is anyways exhausted. So we make the payment of CGST. So 72,000 is there CGST. From 72,500, adjust to 72,000. Fine. So therefore, the total output CGST will get totally adjusted against the input CGST. 500 rupees extra continues to remain. That will be carried forward. Why carried forward? You cannot utilize against SGST. Very simple. CGST credit cannot be used for the payment of SGST. So this 500 rupees, you have no other option but to carry forward the ITC to the next tax bill. Now we come to SGST. What is the total SGST credit which is available? 22,500 here plus 30,000. 52,500 is available. Out of 52,500, if you see here, 62,000 is still left out because on 72,000 SGST payable, we have adjusted 10,000 IGST. So 62,000 is left out still. But SGST credit or balance plus the purchase, SGST on purchases comes to 52,500. So 9,500 SGST needs to be paid. So net amount of SGST which is required to be paid is 9,500. I hope this point is clear. Fine. So therefore, how do you calculate the ITC which is available? Opening balance 50,000, 30,000, 1 lakh. Purchase from New Delhi IGST 90,000. Total IGST is 1.9. CGST total is 72,500 and SGST total is 52,500. These are the ITC which is available when we are doing this problem. Fine. Now we look at another problem. This problem basically covers each and everything. Most of the concepts are covered in the very exhaustive problem. Let us look at this and try to work out this question. All-in-one store is a retail chain of departmental stores having presence in almost all the metro cities across India. Okay, both exempted as well as taxable goods are sold in such stores. Okay, both exempt and taxable are sold. That means straight away you should know that a problem based on rule number 4243 also is covered in this particular situation. The stores operate in rented properties. All-in-one stores pay GST under regular scheme. In Mumbai, the store operates in a rented complex, a part of which is used by the owner of the store for personal purpose. That is, again here, the rent is paid and this premise is used for both the business purpose and the personal purpose. So that is also covered here. All-in-one store Mumbai furnishes the following details for a month. Aggregate value of various items sold. Taxable items 42 lakhs, items exempt 12 lakhs, items not leviable to GST. That is non-GST supply also is covered here, which comes to 3 lakhs. Mumbai stores transfers to another all-in-one store located in Goa certain taxable items for purpose of distributing the same as free samples. This point you need to know value of supply. Value of supply must have been covered. That concept is covered here. Since that chapter is already over, we are doing this problem. So this basically the Mumbai transfers to another store in Goa. That means it is a transfer between the distinct persons. So transfer between the distinct persons, open market value of supplies is to be considered as the value of the supply. So therefore, even though he has sold it for 5 lakhs as per the invoice, you have to take the open market value. The open market value is nothing but whatever price at which the items are sold in the Mumbai store. That is 8 lakhs rupees is to be taken as the value of the supply here. So after the sales, purchase details are also given. Aggregate value of various items procured for being sold in the store. Taxable items 55 lakhs, exempt goods 15 lakhs, items not leviable to GST 5 lakhs. Okay. Total value of purchase also is given. Freight paid to goods transport agency for inward transportation of taxable items 1 lakh. So whatever freight which is paid, on this freight RCM is applicable. So therefore 1 lakh is the total amount. On this freight is required to be paid. RCM is applicable. RCM means again it will come under input tax credit and to be paid in cash. Then freight paid to GTA for inward transportation of exempt items 80,000. Again this also comes under RCM, but exempt sub items are there. So it is exempt items, so exemption will be given for this. Let us look at how to treat this. Then freight paid to GTA for inward transportation of non-taxable items. That also what is to be done. Have to look at it. Monthly rent payable for the complex 5,50,000. In this is very clearly given. 1/3 of the total space available is used for personal residential purpose. That means you know very clearly how much is used towards the personal residential purpose and how much is used for the business purpose. So accordingly, you have to take this treatment. Then activity of packing the items and putting the label of the store along with the sale price has been outsourced. Amount paid for packing 2,50,000. Salary paid to regular staff at the store is 2 lakhs. GST paid on inputs used for personal purposes 5,000 rupees. GST paid on rent-a-cab services availed for transportation, which is not obligatory under any law, 4,000. Please refer to 17 subsection 5. GST paid on items given as free samples 4,000. These are the number of items which are given in this problem. Then what all he is asking? He is asking us to calculate number 1, ITC which you are crediting to the electronic credit ledger. Number 2, common credit which is attributable. Number 3, ITC attributable towards exempt supplies, how much? Eligible ITC out of the common credit and net GST payable. Wherever applicable, reverse charge rate you have to take at 5%, others you take at 18%. Please try to work out this problem. Just take a screenshot and save it so that in another Word document, so that because the problem is going into multiple slides, take a screenshot of this one, everyone, as well as this one, as well as this one, so that please try to work out the problem. Very elaborate problem covering multiple concepts of GST. Multiple concepts of GST. Such a problem can definitely be expected in your examination. Let's try to answer this. So here we have to first calculate what is the total input tax which is involved. Okay, then we have to see how much you have to take it to the credit ledger, etc. So therefore, let us look at what is the total input tax which is involved. So if you go to the problem here, input tax in see first is asking input tax credit. So let us look at totally purchases only now. Then we'll come back to sales and how much you have to adjust and all. We'll come with the fifth question here. So first is input tax only. So here taxable items 55 lakhs. Taxable items 55 lakhs. On this 18% is the input. 55 lakhs into 18% comes to rupees 9,90,000. On this, is there any input? Nil, because it is exempt. On this, any input? Nil, because it is exempt. Now we come to GTA for inward transportation of taxable items. Inward transportation of taxable items, definitely under reverse charge mechanism. Reverse charge mechanism 5% applicable, which can be claimed as the ITC. So therefore 1 lakh into 5%, that is 5,000. Then next, on inward transportation of exempt items also, whatever is there, it is an input tax. Whether you can claim the credit or not, we'll see later. But it is an input tax because RCM is applicable on inward transportation of exempt items also. RCM is very much applicable. So 80,000 into 5%, this will be 4,000. This on this also 20,000 into 5%, it will be rupees 1,000. Total input tax. Then 5,50,000 monthly rent payable for the rent. So 5,50,000 monthly rent. So on this input tax is 18%. So 5,50,000 into 18%, which comes to rupees 99,000 is the input tax on this one. Then amount paid for packing 2,50,000, again 2,50,000 into 2,50,000 into 18%, which comes to rupees 45,000 is the input. Salary paid to regular staff, no input on this because on salary there is no GST applicable, therefore that is nil. GST paid on rent-a-cab inputs used for personal purpose. This is also input tax 5,000. Straight away, this is GST is given again because the way is confusing here. Here the word GST paid is used. So there don't again calculate 5,000 into 18%. Straight away you have to take 5,000. Then rent-a-cab services 4,000 rupees. Free samples another 4,000 rupees. Again, these are also input tax only. These are also input tax only. But how much you have to take to the credit ledger, that we'll see later. So therefore, all these are input tax credit. So input tax are 9,90,000, 5,000, 4,000. 1 second. Okay, 9,90,000 is input here. Let me just highlight that. 9,90,000 is the input. 5,000 is the input. 4,000 is the input tax. 1,000 is the input tax here. 99,000 is the input tax. 45,000 is the input tax. Salary or nothing. Here straight away 5,000 is the input tax. Don't in the flow do 18% of that because that is the GST amount. 4,000 input tax. Free samples 4,000. So therefore, if you see, the total input tax comes to 9,90,000 plus 5,000 plus 4,000 plus 1,000 plus 99,000 plus 45,000 plus 5,000 plus 4,000 plus 4,000. So the total input tax here comes to 11,57,000. This is nothing but your T. So therefore, T comes to T is your 11,57,000. Now you have to work what is T1, T2, and T3. T1 is inputs used exclusively used for non-business purpose. Exclusively used for non-business purpose. So therefore, here you have to first calculate the credit ledger as per rule number 42. Total input tax credit credited to the electronic ledger is T, then T1 plus T2 plus T3. So that is you have to work out. So therefore, now you have found out T, that is the total input tax credit. Then we have to take into example here, how do we do the reversal? So therefore, T1 is inputs used for let us see. T1 here is inputs used for non-business purposes. So what are the inputs which are used for non-business purposes here? First is monthly rent. Monthly rent attributable to personal. Attributable to personal. So therefore, total 99,000 is used. Is very clearly saying 99,000 mein 1/3 is used for personal purpose. So 99,000 into 1/3, it is 33,000. Inputs used for non-business purposes 33,000. Then is also giving inputs GST on inputs used for personal purpose. Personal purpose. How much is that? That comes to rupees 5,000. So therefore, T1 is rupees 38,000. I hope this is clear. So T1 is rupees 38,000. I hope everyone is following. T1 is 38,000. Now we come to T2, which is input exclusively for exempt supplies. So therefore, T2 inputs exclusively for exempt supplies. So if you come back to the problem, what all are the exempt supply inputs here? Freight for inward transportation of exempted items, this one. So this 4,000 is straight away that one. Non-taxable also covered under exempt only here. Exempt supply includes non-taxable supply. So 1,000 also is covered here. 4,000, 1,000 is covered here. So 4,000 and 1,000. 5,000 is for exclusively for exempt supply. So therefore T2 is rupees 5,000. Now next one is T3. What is your T3? This is the same as per rule number 42 we are taken. T3 is blocked credits. So T3 is blocked credit. So what are the blocked credits here? If you go back to the question here, the rent-a-cab is 17 subsection 5. It is totally blocked. And free samples items totally blocked. So this 4,000, this 4,000. 8,000 comes under T3. So this blocked credits will be 8,000. So you know what is T? Okay. T comes to 11,57,000. So therefore you can calculate C1. Okay. C1 is nothing but the common credits which you have to calculate here. So from this C1, T minus T1 plus T2 plus T3. So what is T? Is 11,57,000. 11,57,000 minus 38,000 minus 5,000 minus 8,000. So 11,06,000. Okay. C1 is rupees 11,06,000 is your C1. So common credit, how to calculate? Okay. C2 is C1 minus T4. Okay. What is T4? GST on taxable item. So you know what is C1. Okay. So C2 is your common credit, which is nothing but C1 minus T4. Okay. T4 is exclusively for taxable supply. Exclusively for taxable supply. This is your T4. So what all comes under T4? If you see here, freight for inward tax transportation of taxable purpose, 5,000 will come here. And also the next one is these goods which are procured. 55 lakhs goods procured, 9,90,000. So 9,90,000 plus 5,000. So 9,95,000 is your T4. Okay. So C2 is nothing but 11,06,000 minus 9,95,000. That comes to 1,11,000. 1,11,000 is your common input tax credit. Once you get the common input tax credit, how to attribute? Very simple. Total turnover of exempt divided by total exempt turnover divided by total turnover. Exempt turnover here is 15 lakhs. Again, non-taxable also to be covered, 20 lakhs. So 20 lakhs divided by 75 lakhs. 55 plus 15 plus 5. 75 lakhs. So 20 divided by 75. One second. Let me just go back to the question here. Sorry, this is the aggregate value of the total. So 42 plus 12 plus 3. Okay. Again, interesting concept here. How to arrive the total turnover? This 42 lakhs you have to take. This exempt you have to take. This non-leviable to GST you take. So total comes to 42 plus 12. 54 plus 3, 57. Here, value of supply section 15, you have to take the open market value whenever the transfer is between two distinct persons. So there you have to take 8 lakhs into consideration. So 54, 57 plus 8 lakhs is 65 lakhs. 65 lakhs. And total exempt is 12 lakhs plus 3 lakhs. So 15 lakhs is exempt. 15 lakhs is exempt and 65 lakhs is total. Therefore, 15 lakhs divided by 65 lakhs into 1,11,000 comes to rupees 25 into 15 lakhs divided by 65 lakhs comes to rupees 25,615. 25,615 is your common input tax. attributable to this. So once you get the common input tax credit, the next one is eligible ITC out of the common ITC. Okay, eligible ITC out of the common credit. So 25,615 is attributable to non-exempt supply. Therefore, credit attribute eligible credit is rupees 1,11,000 minus 25,615. 85,385 is your eligible credit. So this is how you have to calculate your credit. So therefore, in this you have worked out the 1, 2, 3, 4, 5 will come to the next step. So 1, 2, 3, 4. If you just summarize here, this is how you calculate the ITC here. The same thing what we did. This is the way you present is like this, and the total input tax 11,57,000. Then inputs attributable to non-business purpose 38,000, and then whatever inputs attributable to exempt supplies is 5,000, 8,000, 11,06,000 is your ITC credit. Fine. This is how you work out the problem here. Exempt supplies is 25,615. Eligible credit is 85,385. Now we come to net GST liability. So what is the taxable item sold in the store? 42 lakhs into 18%, 7,56,000. What in Goa, what you have transferred, that also you have to take 8 lakhs value. 8 lakhs into 18%, 1,44,000. Forward charge is 9 lakhs. Okay. Then less input tax credit. What is the ITC credited to electronic credit ledger? Total 11,06,000 minus 25,315, which pertains to exempt sum. 10,80,385. ITC carried forward to the next month is 1,80,385. Then under RCM, freight paid, you have to take RCM credit. Liability and reverse charges 10,000 rupees. Fine. I hope this question is clear. Very elaborate question based on our concepts of input tax credit, value of supply, everything is covered in this particular problem. Fine. I hope this problem is clear. Any queries, please ask me so that we can revisit this. Fine. So let's take a short break of 8 to 10 minutes, and we shall be back after some time and discuss the further problems based on the input tax credit chapter. So welcome back. Please feel free to shoot any queries if you have. Now we come back to another big problem. We discussed it last class, but we didn't work it out in detail. So we'll just cover this. XYZ Private Limited is a manufacturing company registered under GST in the state of Uttar Pradesh. It manufactures two taxable products, alpha and beta, and one exempt product, gamma. Okay. On 1st October, while product beta got exempted through an exemption notification, exemption available on gamma got withdrawn on the same date. So therefore, 1st October, for all practical purposes, gamma has become taxable and beta has got exempt. This is what you have to remember. Beta is an exempt product now and gamma has become taxable. The turnover exclusive of taxes of alpha, beta and gamma in the month of October was rupees 9 lakhs, rupees 10 lakhs and rupees 6 lakhs. XYZ Private Limited has furnished the following details. Just one moment. Yeah, machinery U purchased on 1st October for being used in manufacturing all the three products. That is, machinery U is being used in all products. Therefore, it is a common capital goods which is being used for all the taxable and exempt supply. Price is 2 lakhs, GST is 36,000. Machinery V purchased on 1st October for used in manufacturing product alpha and gamma. Now, gamma became taxable and alpha is also already always taxable. So therefore, machinery V is used exclusively for the taxable products. 1 lakh is the price, GST is 18,000. Then machinery W purchased on 1st October for being exclusively used in manufacturing product beta. Now, product beta also, it became exempt. So therefore, W is used exclusively for the exempt product of 3 lakhs. Machinery Y, which is purchased on 1st October 4 years ago for being exclusively used in manufacturing product beta. At that point of time, product beta was taxable. 1 second. Product beta got exempted through exempt notification. Therefore, 4 years back, it was taxable. From 1st October, such machinery will also be used for manufacturing gamma. Right? Machinery Z purchased on 1st October 2 years, used in all the three products. Therefore, common capital goods. Raw material used for manufacturing alpha purchased on 5th October 1.5 lakhs, GST 27,000. Raw material used for manufacturing beta purchased on 10th October 2 lakhs, GST 36,000. Raw material used for purchasing gamma purchased on 15th October 1 lakh, GST is 18,000. So these are all the purchases. We have to calculate the amount of ITC created to the electronic credit ledger for month of October. Total aggregate value of common credit needs to be calculated. Common credit attributable to exempt supplies to be calculated. GST liability of the company payable through electronic cash ledger for the month of October to be calculated. Assume that all the procurements are from states other than Uttar Pradesh. That means we have to assume that all products are IGST. Everything is interstate, is very clearly telling. All the procurements are interstate. Similarly, company sells to products in states other than Uttar Pradesh. That means output IGST, input also IGST. Rate of IGST is 18%. Subject to the information given above, assume that all the other conditions necessary have been fulfilled. Ignore interest if any and make suitable assumptions wherever required. Please try to work out this problem. Previous question, why we have not applied rule 86B. See, rule 86B 99% is applicable subject to multiple conditions are there. So therefore, if any problem is given and in the problem he has not mentioned any information as such, so therefore we cannot apply 86B because 86B restrictions are also there. If you have paid in the financial year, you have paid more than 1% already in cash, it is not applicable. If the director has paid more than 1 lakh or 2 lakhs in income tax, it is not applicable. So therefore, if the problem is not very specific on what exactly is the circumstance it is better not to assume the presence of rule 86B. First, let us look at what is asking. Is asking the amount of ITC credited to the electronic credit ledger for the month of October. So therefore, let us first come to each particular item, whether it has to be credited to the credit ledger. First one, machinery U purchased on 1st October for being used in manufacturing all the three products. So therefore, this machinery is used for both the taxable product as well as the exempt product. So therefore, since it is used for both the taxable and exempt, straight away GST can be credited to the credit ledger. So therefore, 36,000 to be taken to ECL, that is electronic credit ledger. Then machinery V purchased on 1st October for being used in manufacturing alpha and gamma. Now alpha and gamma are both taxable products. Okay. So therefore, this will straight away be credited to electronic credit ledger. 18,000 to be again taken to ECL. First question, 36,000 shall be taken. 18,000 also shall be taken. Then machinery W purchased on 1st October for being exclusively used in manufacturing beta. Now beta is a taxable product. Beta, sorry, let us go. You have to get converted. Let's see what it says. Beta got exempted. So beta is an exempt product. Beta is an exempt product. So machinery is purchased on 1st October for the exempt product. Machinery purchased for the exempt product. Okay. The machinery W purchased on the exempt product. So therefore, in this particular situation, the capital goods is exclusively used for exempt product. Therefore, not credited to electronic credit ledger. Only thing, rather than taking all this and subsequently deducting this exempt supply ITC, we are not taking on. Then machinery Y purchased on 1st October 4 years ago for being exclusively used in beta. Now at that point of time, beta was exempt. Okay, and from 1st October, such machinery will also be used for manufacturing product gamma. Okay, so therefore, in this particular situation, machinery Y is used for both taxable and exempt supply. Earlier, it was used only for taxable supply, that is for beta. So that time, beta was taxable. So if you see here, beta got exempt now. So that point of time, 4 years back, beta was taxable. So since beta was taxable at that point of time, already 4 years back, when the machinery was purchased, the amount would have already taken to the credit ledger. So therefore, now it should not be taken. Since already credited to ECL 4 years back, need not take it now. Fine. So therefore, in this particular situation, you will not get the credit because it was already taken. So therefore, now you need not take. Similarly, machinery Z purchased 2 years ago. Here also same thing. Manufacturing all the three products already taken 2 years back. Taken 2 years ago. Therefore, not taken now. So therefore, this also is pretty much the same. So this also nothing will create it. Then raw material used for alpha purchased on 5th October. That means this is a recent purchase which he is talking about. So since it is a recent purchase, definitely for taxable supplies, so this shall be credited to the credit ledger. So 27,000 to be taken to ECL. Okay, 27,000 to be taken to ECL. So I hope this point is also clear. Then Raw material used for manufacturing beta, which is purchased on 10th October. So for beta, he is purchasing on 10th October. In this particular situation, beta, as you see, got exempt. So it is raw material which is used for beta, which is purchased on 10th October. So therefore, for taxable supplies, it will be created. So therefore, in this particular situation, it is used for alpha. Alpha is very much taxable product is taken, but now beta got exempt. So it is used for taking an exempt supply. Okay. Capital goods during exclusively exempt supplies. In that particular situation, this shall not be taken into consideration. So therefore, this will not be taken into consideration here because it is an exempt supply. Okay, not taken as exempt product related. Okay, so this should be taken. Now, a raw material used for manufacturing gamma purchased on 15th October. 15th October raw material was purchased. Gamma at that time was it became taxable. If you see here, exemption got withdrawn. So therefore, it is taxable product. So therefore, this will be taken. So 18,000 to be taken to ECL. So what is the credit which goes to the electronic credit ledger? Is, I think you got some clarity now. 36,000 plus 18,000 plus 27,000 plus 18,000. So total is 99,000 goes to the electronic credit ledger. 99,000 goes to the electronic credit ledger. So this, I hope, is clear. Now we have to look at aggregate value of common input tax credit. Now common input tax credit, what all you have to see? You have to see for what all you are used for all the products. So therefore, if you see here, first one, machinery U, it is used for all the three products. Okay, so this 36,000 is your common ITC. Common ITC. Then machinery V, purchased manufacturing alpha gamma, both are taxable, so this is not common. Okay, then machinery W, purchased for exclusively used in manufacturing beta. So beta, again, this is not a common because it is exclusively for the taxable product. Then machinery Y for all the tiers. So this is used for manufacturing beta, and now it is used for gamma also. So therefore, this is common input tax credit. So this 72,000 has to be taken, okay, as common ITC. Then machinery Z 2 years ago and all the three products, therefore not taken now. So machinery Z, if you see, if you take the common input tax credit here for so this will be taken common input tax credit, and also this one is a common input tax credit. Okay, because it was used for everything at that point of time. So therefore, common ITC is 36,000 plus 54,000 plus 72,000, which comes to 1,62,000. 1,62,000 is the common input tax credit. Very simple. You have to just see whichever is used for all the products and accordingly arrive at the common input tax credit, which is rupees 1,62,000. Then common input tax credit attributable to exempt supplies. This is nothing but E by F into the common input tax credit. So what is the turnover? We have to take into example, you have to check this particular point. So therefore, if you see what is the ITC attributable per month. See, first of all, if you see, everything is a capital good. Since everything is a capital good, you know in rule number 43, it says divided by 60. Per month, useful life of 5 years, you have to take and divide by 60. So therefore, the common input tax credit, common ITC per month is 1,62,000 divided by 60, which is rupees 2,700 per month. Once this 2,700 comes, this is your common input tax credit. How much attributable to exempt supplies? Now let us look at the turnover. What is the turnover which is given? turnover is 9 lakhs, 10 lakhs, and 6 lakhs, right? So therefore, exempt is what? Beta is the exempt one. So beta is 10 lakhs. So 10 lakhs divided by 25 lakhs into 2,700. Okay. So 2,700 into 10 lakhs divided by 25 lakhs. So therefore, that is 1080 is the common ITC which is attributable to the exempt supplies. GST liability, again you have to see here what is the amount which is payable. Sales you see, okay, on alpha 9 lakhs into 18%. Okay, on alpha IGST 9 lakhs into 18%, which comes to 1,62,000. Beta is exempt. Gamma is 6 lakhs into all are IGST only, very clearly given in the problem. Okay, 6 lakhs into 18%, which is 1,08,000. Okay, so IGST on outward supply comes to rupees 2,70,000. From this, add ITC attributable to exempt supply, which comes to 1080. Total 271080. Okay, minus ITC in electronic credit ledger, that is rupees 99,000. Balance rupees 271080 minus 99,000 is rupees 1,72,008. I hope it is clear. This is what we did. You can just go through it once. Common credit 2,700, attributable to exempt supplies 1,080, GST liability IGST 162, IGST on beta is exempt is nil, IGST on gamma 6 lakhs into 18%, outward supply 2,70,000, common credit attributable to exempt is 1,080, IGST payable is 1,72,008. Fine. I hope this is clear. Now we go to some more problems. This we have already seen. This one. This also we have completed all of this. All in one store also we have completed. Okay. So therefore, before we come to the job work, let us first look at few other problems. Then we come back to the job work related provisions. Yeah. PQR Company Limited, registered supplier as a manufacturer of goods. The company provides the following information relating to GST supplied paid on inward supplies during the month of April. Life insurance premium paid by the company for life insurance of the factory as per the policy of the company. Okay, there is no legal obligation for such insurance for the employees, 1.5 lakhs. Raw materials purchased for which invoice is missing but delivery challan is available, 38,000. Raw materials purchased which are used for zero rated supply, 50,000. Works contract service used for repair of factory building which is debited in the profit and loss of the company is 30,000. Company purchased the capital goods for rupees 4 lakhs and claimed depreciation of 44,800 at the rate of 10% on the full amount of 4,48,000. Okay. These are the rates which are given. Then in month of September of the previous financial year, PQR Limited availed ITC of 2,40,000 on purchase of raw material which are directly sent to job workers' premises under a challan. Oh, I'm sorry, this relates to job work. We'll come back to this problem later. I thought it was a 17.5 problem. It has an element of job work, so we'll discuss those provisions and again we'll come back to this. This problem also is very interesting. It talks about the taxpayer who is not required to register under GST, but later he goes for the voluntary registration. At that point of time, how do we take the input tax credit as which was given, as we have discussed in the particular problem with regard to this one in section 18, we have seen this. So how do we do this is what is given in this particular problem. Quanto Enterprises is not required to register under the CGST Act. However, it applied for voluntary registration on 17th September. Registration certificate has been granted to the firm on 25th September. So what is the date which is important for us? The date before 25th September. The date before 25th September, one day before that. So 24th September is the date which is important for us here. The CGST and SGST liability of the firm for the month of September is 24,000 each. The firm is not engaged in making any interstate outward taxable supplies. Quanto Enterprises provides the following information regarding capital goods and inputs held in the stock by it as on 24th September. Okay, inputs held on 2nd September, which is still lying in the stock, CGST 6%, SGST 4,500, 4,500. Inputs received on 21st July, contained in semi-finished goods held in stock 7,575. Value of inputs contained in finished goods held in the stock 2 lakhs. Such inputs were procured on 19th September last year. Invoice also was issued on the same day. IGST 36,000. Inputs valued at 50,000 procured on 13th September lying in the stock, IGST 9%. Capital goods procured on 13th September lying in the stock, CGST, SGST 12,000 each. You are required to compute the net GST payable from the electronic credit cash ledger by Quanto Enterprises for the month of September. You are also required to mention the reasons for the treatment of all the items. Please try to work out this. Yeah. So in this question, if he's asking the net GST payable from the electronic cash ledger. So for that, first you have to look at the outward supply. So the moment it applied for voluntary registration, you have to see what is the turnover which was undertaken here. CGST and SGST liability is clearly given here. Therefore, outward supply we need not calculate, it is clearly given. So therefore, outward tax liability, CGST rupees 24,000 and SGST rupees 24,000 is given. Then what is the ITC which is available is what you have to look at now. Outward tax liability is there. What is the ITC which is available? Okay, ITC, if you see, eligible ITC, first one, items procured on 2nd September lying in the stock. So therefore, if a person goes for a voluntary registration and he gets the registration certificate, the day before he gets the registration certificate is the date on which you have to consider the stock. So therefore, inputs which are procured on 2nd September, which is still lying in the stock. So this ITC can be claimed. ITC can be claimed here on 4,500 also. ITC can be claimed. Then inputs received on 21st July contained in semi-finished goods held in the stock. CGST 7,500, SGST 7,500. Here also ITC can be claimed. ITC can be claimed. Then value of inputs contained in finished goods held in the stock 2 lakhs. Such inputs were procured on 19th September last year. Here's the important point. The invoice of the product of the stock which is there should be issued within 1 year from the date on which he can get the credit. So the date on which he can get the credit here, registration certificate is granted on 25th September. 25th September is the credit. So therefore, the date on which he can claim the credit is 24th September. So invoice was issued on 19th September last year, which is more than 1 year before it was issued. So therefore, on this one, the ITC cannot be claimed because the invoice was issued more than one year before the date on which the credit was eligible. Was issued more than 1 year before the date on which the credit was eligible. I hope this point is also clear. So then, inputs valued at 50,000 procured on 13th September, lying in the stock, IGST, there in the stock, this also ITC can be claimed. ITC can be claimed. Then, capital goods procured on 13th September, lying in the stock. This is an interesting point here. Capital goods credit. Okay, capital goods credit here, you cannot claim. A person who is taking a voluntary registration can take the credit of only the inputs which are there in the stock and inputs which are there in the finished goods or the semi-finished goods. He is not eligible to claim the credit of the capital goods. So therefore, this ITC cannot be claimed. Cannot be claimed. Similarly, this also ITC cannot be claimed. Right? So therefore, these are the ITC which can or cannot be claimed. So output tax liability, if you see, CGST is 24,000, SGST is 24,000. How to adjust the credit? Look at if there is any IGST credit is there. IGST credit first to be used. IGST credit, this 9,000 you can use. So IGST credit first you can use against the IGST, but there is no output IGST. So it can use against a CGST or SGST as per his wish. So let us assume 9,000 he is using towards the output CGST. So 9,000 IGST is adjusted. Okay, 9,000 ITC, 9,000 IGST is first adjusted against the output CGST. Output CGST. Okay, after he adjusts that, IGST credit gets over. Then you look at the CGST credit which is there. CGST credit, much amount is there. So how much 24 9,000 IGST is out. How much CGST credit is there? 4,500 plus 7,500. That's it. 12,000 is there. So from 24,000, 9,000 IGST is used. Then 12,000 CGST is used. Okay. Against output CGST. Okay. Balance CGST is rupees 15,000. CGST credit is rupees 12,000, which is adjusted. Therefore, balance net GST payable is 3,000 for CGST. Now we come to SGST. How much SGST is there? Again, 4,500 plus 7,500. 12,000 is there. 12,000 you straight away adjust. CGST credit you can't use. It's anyways exhausted. 12,000 you use. So net GST payable. CGST is 3,000. SGST is 12,000. This is the way in which you have to calculate the adjustment and the set off of taxes. Fine. So how do you calculate the input tax credit? Whatever in the stock you have to see. Capital goods not applicable, as I told you. This stock more than 1 year before he has purchased it, that also not applicable. This way you have to work out the problem. Now, another very interesting question. Let us go through this question. Once Shopee is a retail supplier of both taxable and exempt goods registered under GST in the state of Rajasthan. Once Shopee has furnished the following details for a month. Details of sales. Supply of taxable goods 50 lakhs. Supply of goods not leviable to GST 10 lakhs. Details of goods purchased for being sold in the shop. Taxable goods 45 lakhs. Goods not leviable to GST 4 lakhs. Details of expenses. Monthly rent payable for the shop 3.5 lakhs. Telephone expenses paid 30,000 for landline phone installed and 20,000 for mobile phones of the employees. Mobile phones are given to employees for official use. Okay. Audit fees paid to CA 35,000 for IT return, statutory audit of preceding financial year, 25,000 for filing GST return, total 60,000. Premium paid on health insurance policies 10,000. Freight paid to GTA at 5% for inward transportation 50,000. GTA inward transportation of taxable goods 1,50,000. Earlier one is not a non-taxable goods. Goods given as free samples not included in the taxable goods of 45 lakhs is 5,000. All the amounts are exclusive of tax. All inward and outward supplies are from or to registered suppliers within Rajasthan. Assume wherever applicable the GST rates at 2.5, 2.55. Okay, 6, 6 and 12 in other cases. For RCM it is 2.5, 2.5 and others it is 6, 6 and 12. No input, no balance in the electronic credit rates. What all has to be calculated? Very exhaustive problem once again. ITC credited to electronic credit ledger, common credit towards apportionment, ITC attributable toward exempt supplies, net GST payable has to be worked out. Kindly take a screenshot of the problems and try to work out this. Wait, I'll tell you when to take a screenshot, then you do. Yeah, take this one. First screenshot. Second. This is first screenshot once again. And second. Third. Okay. Please do try to work out the problem. Okay. Now let us look at what is all. First is asked the ITC credited to electronic credit ledger. So we'll first look at the expenses here. So first one, details of purchases 45 lakhs. So therefore, for this 45 lakhs, what is the ITC which comes? ITC is 45 lakhs into CGST 6%, SGST 6%. 2,70,000. CGST 2,70,000. SGST 2,70,000. Then goods levied and not levied to GST, nothing will come. Then monthly rent payable for the shop. So on this GST of monthly rent, 3,50,000 into 12%. So 3,50,000 into 6%. So CGST is 21,000 and SGST is 21,000. Then telephone expenses, landline at shop and 20,000 towards the mobile phones. So both are towards the taxable things also, because mobile phones of employees also are official expenses, no restriction in 17.5. So therefore 50,000 into 6%. So 3,000 CGST, CGST 3,000, SGST 3,000. Fine. These are the input taxes which are paid. Okay, then audit fees paid to chartered accountant, 35,000 for ITR and statutory audit 60,000. So both are subject to GST. There is no differentiation as such. So CGST 3,600 and SGST 3,600. Premium paid on health insurance policy taken for employee as a company policy. Since this is not obligated, okay, since this is not obligated, ITC is not allowed. So ITC on employee insurance policies will be allowed only if it is obligated by any law in force. But if it is done as a company policy, then the credit will not be eligible. So therefore, no credit as per 17 subsection 5. Then freight paid to GTA, service taxable at 5% for inward transportation of goods, not leviable to GST. Okay, not leviable to GST. In this particular situation, the freight whatever is paid under RCL, since it relates to exempt supply, there is no input tax credit here. So therefore, no credit due to exempt supply related input. Okay, no credit due to exempt supply related inputs. Then freight paid to GTA service for inward transportation, 1,50,000. On this, it is very much applicable. So 2.5% CGST, 2.5% SGST. So therefore, CGST 3,750 and SGST 3,750. Okay, then goods given as free samples, not included in the taxable values. Free samples, ITC given is blocked as per 17 subsection 5. So therefore, this one also no credit as per 17 subsection 5. Okay, so I hope the credit concept is there. So the first thing what we see, what is the ITC which is created to the electronic credit ledger. ITC which is created to the electronic credit ledger. What all has to be taken? First, here CGST, SGST, anyways, both are the same. So let us see here. First one, 2,70,000 plus 21,000 plus 3,000 plus 3,600 plus 3,750, 301,350. Okay, 301,350 is your electronic credit. So CGST 301,350 and SGST also 301,350. Common credit available for apportionment, you have to take the total ITC and reduce the ITC applicable on taxable goods. Fine. So therefore, total ITC is this one created to this thing. From this, you have to reduce ITC on taxable goods and ITC of RCM on GTA taxable supply. So what has to be reduced here? You have to reduce, if you go back here, taxable product, this 2,70,000. So 301,350 minus 2,70,000, you have to reduce, and then you have to see what is paid to the GTA for taxable supply. That is 3,750. So 31,350 minus 3,750. Fine. 27,600. 301,350 minus 2,70,000 minus 3,750. So 27,600 is the amount. Common credit, this thing is 27,600. Therefore, $27,600 GST and rupees 27,600 is GST. Okay, that is your common credit. Now, how to determine this? Again, based on the turnover. So, what is the exempt supply turnover here? The exempt supply turnover is 10 lakhs. Taxable supply is 50, so total is 60 lakhs. So 1 by 6, 10 lakhs by 60 lakhs. So therefore, this is nothing but 27,600 into 10 lakhs divided by 60 lakhs. So therefore, 27,600 divided by 6, 4,600. 4,600 ITC. 4,600 CGST and 4,600 SGST. Okay. And net GST payable, how to calculate this one? You have to see what is the taxable as per the forward charge and reduce the ITC. Okay. Therefore, this is the ITC credited. Common credit 4,600 on forward charge. So taxable goods supply is 50 lakhs into 6%, 3 lakhs. ITC you credited to the credit ledger. GST liability on reverse charge, you have to take this also into account on taxable and non-taxable goods. Total liability and reverse charge is 5,000. So net GST payable is 8,250. So this 296 250, how did you get this? It is nothing but 301,350. 301,350 here, which is credited to the electronic credit ledger, and how much ever is attributable to exempt, that is 4,600. 301,350 minus 4,600, 296,750 is nothing but the eligible ITC. So this one, how you got? 301,350 minus 4,600. I hope this is clear. Same thing here. Okay. So net GST payable 3,250 is come here, and then RCM you have to add, and you get the total GST liability. So with this, we come to the end of another question based on the input tax credit. Now we go back to what we left out here in section 19. 143, which is job work. We'll just go through what exactly is job work and conclude today's session, so that next session we just do number of problems and all the amendments which are to be covered in the first 4 chapters. Yeah. So job work sector constitutes a significant industry. It is processing of the goods which are supplied by the principal here. Term is very simple. What exactly is job work? When the manufacturer manufactures a particular product, and he feels that the main manufacturing activity is to be done by him, and the smaller things where certain small works have to be undertaken, he feels that outsourcing to someone is more better rather than manufacturing himself. So he sends the goods to the job worker, and the job worker processes those goods and send it either back to him or sends it to the customer of the principal manufacturer. Fine. This is what he does. So therefore, the term job work itself explains the meaning. It is the processing of the goods, either inputs or semi-finished goods, supplied by the principal for further processing, right? So whenever the principal manufacturer has a goods, when I say principal in the job work terminology, that means it refers to principal manufacturer. So this principal manufacturer, what he does is he manufactures the goods, and apart from the manufacture, he also sends it for the processing of the goods. That is a job work process for further processing. Now, many facilities, procedural concessions have been given to the job worker as well as the principal supplier who sends the goods for the job. Many such features are given. Section 19, 141 and 143 stipulate the provisions pertaining to job work. State GST laws also prescribe identical provisions in relation to the job work situation. These are the sections which are covered with regard to the same. So who is a principal here? The principal is a registered person who sends the inputs or capital goods to a job worker for carrying out the job work. So for carrying out the job work, he sends the inputs or capital goods to the job worker for carrying out the job work. And many facilities are given. The whole idea is to make the principal responsible for meeting compliances on behalf of the job worker on the goods processed by him. Considering basically job workers are very small persons, small processing units who usually do not have the bandwidth for getting themselves registered under GST and the other provisions. So therefore, here always in the job work under GST, the principal manufacturer is the registered person who sends the goods for the processing and the job work. And the main idea is to make the principal responsible for the compliances of the job worker. Special provisions are undertaken by the GST law with regard to the removal of the goods and also receiving it back after the processing without the payment of GST. So therefore, once the principal sends it to the job worker, and then the job worker can send it back to him, the timeline is specified. If the same activity happens within the timeline, there is no necessity of paying the respective GST here. The benefit of this provision shall be applicable both to the principal and to the job worker. It shall be applicable to both these persons. Again, 268 of the CGST Act defines the term job work as any treatment or process undertaken by a person on goods belonging to another registered person. This is the definition of the job work under 268. It can be any treatment or process undertaken by a person on the goods belonging to another registered person. The most significant part of this definition here is the term registered person. That means the job work refers only to the treatment or process which is undertaken on the goods. The goods have to be sent by a registered person. So any person sends the goods, it will not come under the job work of the GST terminology. Registered person has to send the goods. Only then it comes under the job work. Ownership does not get transferred to the job worker, but it rests with the principal only. Fine. So therefore, ownership does not change. That is the most important point you have to remember. Ownership rests with the principal only. The job worker, in addition to the goods received from the principal, can also use his own goods for providing the services of the job work. Very, very interesting point. Apart from whatever goods he is received by the principal, he can also use his own goods for providing the services of the job work. This also is possible. Again, when does the job worker require to get himself registered? Is only when his aggregate turnover on an all India basis exceeds the above threshold limit, regardless of whether the principal or the job worker are located in the same state or in the different state. So therefore, job worker can get registered only if his threshold limit is increased. It doesn't matter where the principal is located. Principal can be in one state and job worker also can be in the other state. Again, these definitions we have already seen. Taxable person who is registered or liable to be registered under 20 or 24. Job work definition also we have seen. Jet treatment or process, another registered person. Taxable supply means a supply of goods or services liable to tax. We have seen all these definitions, nothing new in this. Section 143 of the CGST Act 2017 talks about the job work procedure which is to be followed. The main important point here to be understood is that the principal can send the goods to the job worker without payment of any tax. That is the most important point which you have to remember. So a registered person who will nothing but the principal can send the goods, inputs or capital goods. Again, to the job worker, you can either send your inputs, which is nothing but your stock, or you can send your capital goods also for any treatment which is to be undertaken. Under intimation, you will send, and subject to certain conditions without payment of tax to a job worker, and from there to another job worker. And after completion of job work, he can bring back such goods without payment of tax or remove the processed goods from the job worker's premises for supply to the customer. Such goods need to be removed under intimation to the proper officer and subject to certain conditions. Now, what does this mean? There is a registered person who is a principal. This principal, what he does, he has certain inputs. That is nothing but the stock on which some treatment has to be done. He will send these inputs to the respective job worker without payment of tax. From there, he can send it to another job worker also. And after completion of that process, he will bring back that goods without payment of the tax. So here, if you see, the goods are moving from the principal's office to the job worker's office without payment of tax. So from there, he'll send it to the job worker first. From there, he can send it to another job worker, or he can remove the processed goods from the job worker's premises for supply to the customer. So therefore, from the job worker, he can either say get it back to him, or he can send it directly to the customer. Such goods need to be removed under the proper intimation. The principal is not required to reverse the ITC availed on the inputs or capital goods dispatched to the job worker. So principal is not required to reverse the ITC. Very important point. Whatever inputs here the principal has procured, whatever capital goods the principal has procured, on that GST you will get the claim. Just because he's sending it to the job worker for further treatment, it doesn't mean the ITC has to be reversed. So he can send the inputs or capital goods to the job worker without bringing to his premises also. That means if I'm purchasing a stock, I'm purchasing the products from one place. I can tell that person not to send it to me. If I anyways have to send it to the job worker, I can tell him you send it to the job worker, because anyways, so directly also he can go there. So the goods can go directly from the supplier to the job worker premises, and this person, the recipient, can claim the input tax credit. That facility also is available. But there is a time limit which is mentioned. That is what is critical for us to understand. In excise law, the time limit was 6 months and 1 year, whereas now in GST, the return time period is fixed at 1 year and 3 years respectively. That is inputs which you are sending to the job worker. For you to still claim the input tax credit and not reverse the input tax credit, the main important point is that they have to be returned to the principal within 1 year. In case of inputs, in case of capital goods, they have to be returned to the principal within 3 years from the date of sending the goods to the job worker. So whenever you are sending the goods to the job worker, within 1 year, in case of inputs, he has to return it back, or within 3 years, in case of capital goods, he has to return it back. However, this 1 year also may be extended by the commissioner on sufficient cause. If there is a genuine cause, the commissioner can extend this period of 1 year or 2 years for another period not exceeding 1 year and 2 years respectively, right? Another 1 year for inputs, another 2 years for capital goods can be done. After processing, what can the job worker do? He may either send it to another job worker for further processing, dispatch it to any other place of business of the principal without payment of tax, or supply to the ultimate customer against the payment of tax. But this payment of tax will trigger to the principal, not to the job worker. Fine. So how do you do the direct supply of goods from job worker premises to third party? On declaring the premises of the job worker as his additional place of business in the registration. So if you want to directly supply the goods from job worker premises to the third party, the main condition is in your registration certificate, you should declare the place of business of the job worker as an additional place of business. Fine. But declaration is not required when job worker himself is registered under section 25. That means he has a GST registration, or the principal is engaged in supply of notified goods. So therefore, in such cases, the supply will be regarded as if the supply is done by the principal, not by the job worker. Clarified value and time and place of supply will be in the hands of the principal irrespective of the location of the job. Wherever the job worker's place of business is there, it is immaterial. The concepts of supply, the GST trigger, all will be applicable only with respect to the principal and not to the job. Further, invoice also to be issued by the principal. In case of exports, sometimes exports also will happen directly from the job worker. Exports also is there. The LUT is letter of undertaking. Letter of undertaking is to be issued by the exporters, whoever are exporting the goods or services. So they have to execute the LUT clearly. These principles will apply mutatis mutandis. Same way, even in case of supply of waste and scrap generated during the job. So supply of waste and scrap also, it is the same thing. Before supply of goods to the job worker, he would be required to send intimation, description, what all you are sending. You have to give an intimation to the proper officer. Responsibility for keeping the accounts. Again, job worker is not concerned with maintaining the accounts of the inputs or capital goods. All the responsibility is totally with the principal only. Very, very straightforward, very, very simple. So what happens in case the goods are not returned within the specified time limits? If the goods are not returned within the specified time limits, or they are not supplied by the job workers premises within the time limit, that is, what is the time limit which is given? Within 1 year for inputs and 3 years for capital goods, then it shall be treated as a supply between the principal to the job worker from the day when it was sent for the job work. So that means in case he has example here, he sent goods on Feb 1st. Okay, Feb 1st means inputs. Inputs he has sent on Feb 1st, 2022. Inputs not returned till April 1st, 2023. Then it will be supply in hands of principal. Again, interest also to be calculated with effect from Feb 2022. Very important point. Okay, so this you have to remember. Supply goods sent also of a character of supply where it is neither received by the principal nor supplied by the principal from place of business within 1 year or 3 years of the extended period for being sent out. Responsibility for sending the goods for the job work, as well as bringing back the goods or supplying them later to the subsequent customer. Total responsibility is given to the principal only. Again, date of supply is always the date on which the inputs or capital goods are sent to the job worker. Interest also will be payable on the tax. Goods are returned after the stipulated tax period. What will happen? It will be treated as a supply of goods by the job worker to the principal, and the job worker will be liable to GST if he is liable for registration. Fine. So therefore, what happens here in this particular situation? If after this period of 1 year or 3 years he returns the goods, it will be a treatment supply by the job worker to the principal. Accordingly, he has to pay the GST. Okay. Also, it is reiterated no requirement of either returning back or supplying the goods from the job worker as far as molds, dies, jigs, fixtures, small accessories like molds, dies, jigs, fixtures, tools, etc. There is no requirement of returning or supplying the goods back from the job worker. Inputs also include intermediate goods which arise from any treatment or process conducted by the job worker or the principal. Intermediate goods are coming up in goods arise in the course of manufacture. That also is covered. Fine. So therefore, ITC and job work, what are the provisions which are given? Let us look at those. Section 19 subsection 1 talks about the principal shall, subject to the conditions and restrictions, be allowed ITC on inputs sent to the job worker for job work. So whatever is there in job work. So therefore, here, why is there is a separate section with regard to job work? Because in this, certain conditions of section 16 are not being in sync. That is why a separate provision is there. Therefore, that is why 19 subsection 2 reads saying that notwithstanding anything contained in clause B of subsection 2 of section 16. So whatever be the conditions covered under section 16, the principal shall always be entitled to take the input of the input tax on inputs, even if they are sent directly to the job worker without being first brought to the place of business. One of the important conditions for claiming the input tax credit is the goods must have been received by the taxpayer. So goods here are not received by the taxpayer. It is going directly to the job worker's premises. That is why still, even if it is directly sent to the job worker without being first brought to his place of business, then also ITC can be available. Again, the provision here which is given, inputs sent for the job work are not received back by the principal after completion of the job work or otherwise, or are not supplied from the place of business. Okay, in accordance with 143(1)(a) or B within 1 year, it shall be deemed as if the inputs are supplied by the principal to the job work on the day on which it was sent out, provided where the inputs are directly sent to the job worker. Sometimes inputs will be directly sent by the principal's supplier, directly will send to job worker. Then in that case, period of 1 year will be taken from the date on which the job worker has received the inputs. 19 subsection 4, same thing, talks about capital goods subject to the conditions and restrictions. He can be claimed the input tax credit on capital goods sent to the job worker for the job work. 19 subsection 5, notwithstanding anything contained in 16(2)(c), he will take the credit of the credit even if the capital goods are directly sent to the job worker for job work without being brought to his place of business. 19(6), again continuation, where the capital goods are not received back by the principal within a period of 3 years of being sent out, it shall be deemed that such capital goods have been supplied by the principal on the day when it is sent out. Very simple. Again, 3 years, if it is directly sent, shall be on date of receipt of capital goods taken into consideration. Nothing shall apply to molds, dies, jigs, and fixtures or tools sent to the job. Rule 45 speaks about certain conditions and restrictions with respect to inputs and capital goods sent to the job worker. That means when you can claim the input tax credit and what are the things you have to be keeping in mind is what is covered here. Inputs, semi-finished and capital goods shall be sent to the job worker under the cover of a challan issued by the principal, including where they are sent directly to the job worker and were sent from one to the other job worker. Challan may be issued by the principal or job workers because there is no invoice here. Therefore, a challan will be there. In that challan, what all will be there? Quantity of the goods, description of the goods, where the goods are sent to one to the other or returned to the principal will be there. In case job worker sends it to another job worker, the challan, whichever is endorsed by one job worker, will also be endorsed by the other job worker. He will indicate the quantity and description where it is sent by one job worker to the other and are returned to the principal. The challan, whichever is issued, shall be contain the details as specified in 55. So nothing of quantity of goods, description of goods, value, everything has to be given. The details of challans in respect of goods dispatched or received during 1 quarter shall be furnished is this return called ITC 4. It is a quarterly return. In this ITC 04, after the quarter is completed, within 25th of the month, you have to submit this or such other period as may be extended by the commissioner by notification in this behalf. In section 143, it shall be deemed that inputs or capital goods had been supplied by the principal to the job worker on the day where it was sent out, and supply shall be declared in form GSTR1 and principal shall be liable to pay the tax. So whenever the inputs or supplies are there, it shall be deemed as if they have been supplied by the principal, and the same shall be declared in GSTR1. Whenever the situation is the time limit or not, while time limit or not followed, this is what it happens here. Moving forward, principal will take the credit even if they are sent directly. All this we have seen. Same provisions we are just summarizing. Where inputs are directly received at the job worker's premises, period of 1 year shall be calculated from the date of receipt of the inputs. Capital goods, it is 3 years from the date of receipt. Fine. Some examples here. Supplier of notebooks for schools sends the paper of required dimensions and GSM to job worker for making the notebooks as per the design. Government changes the specifications of the notebooks for supply. Supplier sends a fresh stock of paper with fresh instructions to the job worker and instructs him to hold the earlier consignment in buyer's form. New or easily sold paper lying the godown for over a year. 100% in this case, since more than 1 year the inputs are there, it shall be treated as a supply between the supplier of notebooks to the job worker, and the GST has to be paid along with interest. So situation rules where the goods are sent by the principal to only one job worker. He has to send the inputs or capital goods under the cover of a challan which is issued by him. What are the rule details which are given in the rule 55? Date and number of delivery challan, name, address, GST and number, HSN, description of goods, quantity, etc. is there. The principal shall prepare a triplicate delivery challan for sending the goods. 2 copies of the challan may be sent to the job worker. Send 1 copy along with the goods when returning to the principal. So all this will be covered. Form ITC4 has to be filed by the principal. Every quarter, what are the goods which are sent to the job worker, what process capital goods inputs has to be given by him. What happens when goods are sent from one job worker to the other job worker? In that case, they move under the cover of a delivery challan. Either the principal can issue or the job worker can issue. Alternatively, whatever challan is issued by the principal, same will be endorsed by the first job worker who is sending it to the another job worker, indicate the quantity. Where the goods are returned to the principal, he should send 1 copy of the delivery challan while returning the goods after carrying out the job. Where the goods are sent directly by the supplier to the job worker without coming to the place of the principal, in this case, goods will directly move from the place of business of the supplier to the place of the job worker with copy of invoice issued by the supplier in the name of the buyer. So in the name of the buyer, the invoice has to be issued. Job worker's name and address also should be mentioned as the consignee. Further, the buyer shall issue the delivery challan and send the same to the job worker directly. So when goods are returned in piecemeal, what happens? Piecemeal quantities means step by step is going on returning. Whatever challan is issued by principal cannot be endorsed. Fresh delivery challan needs to be issued because that original delivery challan will have details of multiple goods. But in case you are returning in bits and pieces, new challan, fresh challan has to be there. Responsibility of the principal to include the details of all the delivery challans related to the goods to job worker with their 25th. The ITC4 has to be submitted. In case of waste or scrap, 143.5, any waste or scrap generated can be supplied directly by the job worker from his place of business on payment of tax if he is registered. In case if he is registered, he himself can supply and declare in his returns. If he is not registered, it will be as if it is a supply by the principal. Fine. So these were the provisions of job work. There are some questions. We do such all these questions based on the provisions, and we will also cover certain further elaborate questions based on input tax credit in our next session. And after that, we will in the next session we'll also cover the important amendments which are to be taken into consideration from for the first 4 chapters which I had covered. Fine. So I hope everyone are clear. Any queries still here with regard to job work? I think we are finally close to be almost. We have ended the input tax credit chapter. So there is. I hope things are clear for you, because you should ensure that you're able to understand, you're able to follow what is being taught, so that you clearly get the concept in no uncertain terms. So the agenda for the next class, our next class is on Sunday at 6 p.m. The agenda for the next class, that is my final class with all of you for input tax credit, will be, we'll cover some elaborate problems on input tax credit. We'll cover some problems based on job work, and we will look at the amendments which are applicable for the topics what I had taken. So therefore, thank you very much for attending today's session. I wish you all the best. Hope your preparation is going on fine, and hope the input tax credit is there. Please feel free to keep asking any sort of queries. The previous sessions also what I've taken, please feel free to ask your questions. So thank you very much, and good night, everybody.